$12 a week is what most people spend on a single lunch, but quietly reinvested into the right stocks, it has a mathematical endpoint of over $4,000 a month in passive income. So let us start from the very beginning, because this entire strategy is built on one foundational concept: dividends. When you buy shares of a company, you are not just buying a ticker symbol on a screen. You are buying a tiny slice of an actual business. And some businesses, the strong, profitable, well-established ones, take a portion of their earnings and distribute it directly back to shareholders. That payment is called a dividend. Think of it like being a silent business partner. The company runs its operations, earns its profits, and then cuts you a check just for being an owner. Most companies pay these quarterly, meaning 4 times a year, though some pay monthly. The amount you receive depends on something called the dividend yield, which simply measures what you earn in dividends relative to what you paid for the stock. So if a stock trades at $100 and pays $4 annually in dividends, that is a 4% yield. Clean and simple. Now here's where most people miss the real power. Dividends do not force you to sell anything to get paid. Your shares stay exactly where they are, continuing to grow in value, while also depositing cash into your account. And the really exciting part is that many companies raise their dividend payments every single year as their profits grow. That rising payment over time is called dividend growth, and it is one of the most underappreciated forces in all of investing. But there is one decision you will face early on that determines whether you build wealth slowly or at an almost exponential rate. When those dividend payments hit your account, do you take them as cash or do you put them straight back to work? Reinvesting your dividends is called a DRIP, which stands for Dividend Reinvestment Plan. When you have DRIP activated, those payments automatically purchase additional shares instead of sitting idle. Here is why that matters enormously. Your new shares then generate their own dividends. Those dividends buy even more shares. And the cycle keeps building on itself without you doing anything. It is compounding in its purest form. The longer you let it run, the more aggressive that growth becomes. What feels painfully slow at the beginning accelerates into something genuinely powerful in the later years. Now, before we get into the actual stocks, let us talk about the mistakes that trip people up, because avoiding these is just as important as picking the right investments. The first mistake is chasing yields that seem almost too good to be true. If you see a stock advertising an 8 or 10% dividend yield, that number should actually make you nervous rather than excited. Extremely high yields often signal that something is wrong. Either the stock price has already collapsed, or the company is paying out more than it can sustainably afford. When conditions get tough, these companies typically slash their dividends, which means your income drops and the stock tanks simultaneously. This is called a dividend trap, and it has burned countless investors. The second mistake is ignoring the payout ratio, which tells you what percentage of a company's earnings are being used to fund the dividend. If a company is paying out almost everything it earns, there is no cushion left for rough periods or future growth. You want companies that reward shareholders while still retaining enough earnings to keep the business healthy and expanding. Third mistake is putting everything into a single stock or a single sector. If your entire income stream depends on one company having a good quarter, you are one bad earnings report away from serious pain. Spreading your investment across different industries protects you when one area hits turbulence. And the fourth mistake, the one most beginners completely overlook, is taxes. Dividends are typically treated as taxable income. A straightforward way to handle this is by investing inside a tax-advantaged account like a Roth IRA. With a Roth, your contributions go in after tax, but all the growth and all the dividend income that follows comes out completely free of taxes in retirement. That difference in compounding without an annual tax drag is enormous over decades. So now that you know what to avoid, let us build the actual portfolio. Picking strong dividend stocks comes down to finding companies that balance reliable income today with consistent growth tomorrow. You want yields in roughly the 2 to 5% range, sustainable payout ratios, strong underlying cash flows, and a track record of raising dividends year after year. Here are 5 positions that check every one of those boxes. First is the Schwab US Dividend Equity ETF, ticker SCHD. This is the anchor of the entire portfolio. Rather than betting on a single company, SCHD gives you exposure to over 100 quality dividend-paying businesses in one purchase, all screened for financial health and consistent payouts. It carries a dividend yield of 3.76%. a dividend growth rate of over 10% annually, and has appreciated about 8.26% per year in price. It is the foundation that gives the whole strategy stability. Second is NetEase, ticker NTES. This is a major Chinese technology company with significant operations in gaming and e-commerce. The yield is lower at 1.89%, but the dividend growth rate is a staggering 24.82% annually, and the stock has appreciated 19.36% per year. NetEase is the high-growth engine of this portfolio, the position that keeps pushing total returns higher over time. Third is Morgan Stanley, ticker MS, one of the most well-respected financial institutions on the planet. The yield sits at 2.58%, but the dividend growth rate over the past decade has been an exceptional 22.4% annually, paired with 17.18% annual price appreciation. Morgan Stanley brings financial sector strength and remarkable dividend growth to the mix. Fourth is CubeSmart, ticker Cube. This is a real estate investment trust focused entirely on self-storage. The reason self-storage is such a durable business is that demand exists in virtually every economic condition. People need storage when they move, when they downsize, when life changes. CubeSmart yields 5.17% with a 12.51% dividend growth rate. It is the income anchor of this portfolio. Fifth is Illinois Toolworks, ticker ITW. This industrial company has been operating for over a century, manufacturing across a wide range of industries. It yields 2.47%, grows its dividend at roughly 11.79% annually, and has appreciated 11.75% per year. It is not flashy, but it is remarkably consistent, the kind of holding that just quietly builds wealth decade after decade. When you average out the yields across all 5 positions equally, the portfolio carries a combined dividend yield of approximately 3.17%. The average dividend growth rate across the portfolio comes to around 16.39% annually, and the average annual price appreciation lands near 12.07%. Now let us run the actual numbers and see what happens when someone we will call Marcus commits to investing $12 every single week, splits it equally across these 5 positions, and turns drip on from day one. After 1 full year, Marcus has contributed about $624. Small starting point? Absolutely. But that is not the point yet. After 5 years, the portfolio has grown to approximately $4,263. Compounding is beginning to do its job, but the real momentum is still building. After 10 years, Marcus is looking at roughly $13,423, without ever depositing more than $12 a week. He has not touched it, has not stressed about it, has not made any major decisions. The machine is just running. By year 20, the portfolio crosses $85,000. Now Marcus starts to feel it. The dividends being reinvested are themselves generating meaningful additional dividends. The snowball has serious size behind it. And then year 30 arrives, Marcus's portfolio is projected to reach approximately $593,000 in total value. His annual dividend income at that point would be roughly $52,000. That breaks down to over $4,300 every single month, arriving in his account automatically without him selling a single share. Here's the part that really hits differently when you see it written out. Over those 30 years, Marcus would have contributed just $18,720 of his own money. $12 a week, every week, for 30 years. The rest of that $500,000 portfolio, more than $574,000 in total added value, comes from capital appreciation and reinvested dividends, doing exactly what compounding is designed to do when you give it enough time. The whole secret here is not finding some magical investment or timing the market perfectly. It is committing to a modest but consistent amount, selecting fundamentally sound dividend-growing companies, reinvesting everything religiously, and protecting your gains through tax-advantaged accounts whenever possible. $12 a week is 1 skipped lunch. It is 2 fewer coffees. It is a decision so small it barely registers in daily life, but made consistently over time, pointed at the right companies, it turns into a second salary that works for you around the clock without asking for anything in return. If you found this valuable, drop a comment below telling me where you are starting from. Because everyone begins somewhere. Like this video, if you want more breakdowns like this, subscribe so you never miss the next one, and click the video on screen right now to see how a different starting amount can build an even bigger monthly income stream.